So share trading, what are the various ways you could buy and sell shares? Well, one of them is through digital apps. There's one out there called Robinhood, and that one came to the forefront last week. So what have you got? Essentially, the key players in what happened at the end of last week are small retail investors represented by this fluffy toy. And then you've got the hedge fund sharks, if you like, and small retail investors taking on sharks individually, not a good idea. That's not a match. Come back to what they're actually doing in a moment. So you need lots of them, okay? So basically, how do you get lots and lots of retail investors together, and a few pros as well hidden in there amongst the sort of innocent looking fluffy toys? Well, the answer is basically you organize them through bulletin boards, subreddits as they're known. Reddit's a big one. Wall Street Bets is a subreddit. What you do basically, to cut to the chase for those people wondering what I'm talking about, is you get a chat room on the internet together through one of these sites. There are potentially 7 million account holders available. Now that is a decent number of people. And if you can organize them, rally them all to buy a small group of stocks, let's say GameStop in particular, if you can get them to buy that simultaneously, you are going to have enough power potentially in the market to move the price upwards. Now, why are you trying to do that? Well, quite simply, a lot of people thought buy low, sell high. So you buy a stock, buying pressure moves it up, you sell for a higher price, make some money. But my goodness me, the end of last week, GameStop went up by something like 1,600% in a very, very short space of time. That's a massive rise. So objective number one, make some money. Objective number two, take out some of these sharks. Now, how do you do that? Come back to that in a moment. And objective number three, if you like, is to sort of punch the nose of Wall Street. There are people out there who don't like the way that Wall Street operates and wanted to kind of show that retail investors have some power. And then you've got people who can be corralled behind these bulletin boards because frankly, they've been in lockdown. They're a bit bored. They haven't spent much money. They'd normally take a punt on sports matches, cajoled into basically joining this retail army. So on the one side, three key players. On the one side, you've got hundreds of thousands of account holders potentially organized through one bulletin board, one app, ready to go. They can trade quickly and cheaply, okay? On the other side, you have the hedge funds represented by the fluffy killer whale. Now, why do you want to target these hedge funds, you might ask? Because what these funds do is something that sounds a bit unusual. They look to target companies that they think are doing badly, that are financially weak, and they look to make money from falling share prices. So you've got people trying to come in to make money from a rising price by literally driving the price up against these hedge funds who do things called short sales. Now, to save myself a bit of time here, this is a description of a short sale. So this is the whale, the killer whale. Imagine you've got hedge funds who think GameStop is a weak company, the financials are not strong, it's going nowhere, let's try and make some money out of betting on falling prices. How would you do that? Well, in a nutshell, a short sale is you borrow shares in the company you're targeting. These are the killer whales. You then sell them on in the open market. You wait, hoping the price will fall as you expect, and then you buy them back. So think about it, you've sold before buying, but if you sell high and buy back low, you'll make money. Make up some numbers, the sale is at $2, the buyback is at $1, you've got $1, then you need to return them to the original lender. Who is that lender? Potentially an institution, could be a pension fund. Why were they happy to lend stock to the killer whale hedge fund manager in the first place? Well, because as a pension fund, you sit on loads of stock. Why not earn a bit of interest from a hedge fund for loaning it out short term? So there's the scenario. Now, how do you catch out a hedge fund in that situation? Well, the answer is between stages 2 and 3. If the hedge fund basically is waiting for the share price to fall on GameStop and it doesn't, it starts rocketing. Why? Because in come this retail army through the Robinhood app driving the price up, then they got a problem. They've still got to buy back the stock and return it. Otherwise, you've got one big pension fund manager that's going to be seriously upset. You're in breach of contract. So now they've got to find the stock, but horror of horrors, it's not dropping, it's actually rising. Worse than that, if you're a hedge fund with a big short position, you go into the market looking for stock, that's rising, you're going to drive it up even further, because to close a short sale, you need to be buying stock. So you've got a double whammy effect here. You've got this retail army, okay, driving the stock price up, and you've got hedge funds now, the whales, panicking and also driving the stock price up, trying to get to stage 4 where they can return the stock they've borrowed. It's called a bear squeeze or a short squeeze, because the price is rocketing, and what's more, there might not be a lot of stock around for you to actually get your hands on. So there's the scenario, all right? And essentially what happened, quite a few high profile hedge funds lost money, all right? And a lot of investors who got their timing right, which is notoriously difficult to do, will have made some money on the kind of Robinhood side of the equation, all right? Now, something else happened, and this is where I want to come to some conclusions about this whole thing. Something else happened that was unusual last Friday, which was that Robinhood was faced with such a big army of buyers that at one point they actually had to suspend trading on their platform, their app, in the very stocks that these people are trying to make money from. And that upset a lot of people. Now, why is that? I did say there'd be a bit of technical stuff here. So I'm just going to reverse this board for a moment, all right, and put it this way around. So the reason is, for those people wondering, because the trading suspension is still being investigated. There are people suing Robinhood because they claim it was outrageous that trading was halted. It bought the hedge funds time, is the accusation. But actually what happened was, if you imagine, the Robinhood app in the middle is trying to match buyers and sellers, right? It's a trading platform. So you can put a sell instruction, click of a button, buy instruction, all right? And basically, if you imagine, if you've got enough trades going through that app in one direction, essentially the app will get a phone call at some point from the central clearinghouse called the DTCC in America. And what they do is they try and they help to maintain a stable market. And a stable market means that if somebody agrees to buy shares, they will pay for them. And if someone agrees to sell shares, they will deliver them. Because otherwise the market would be chaos. You'd have people making promises they can't keep. So the DTCC margin people like Robinhood. They say, well, if you're going to basically in 2 working days time, which is what the market behind the scenes, the plumbing works on, if in 2 working days time, you're saying all this cash will arrive in the right bank accounts, all the right stock will get delivered to the right place at the right time. If you're going to underpin all these trades basically in the retail market, you need to collateralize them. You need a security deposit with us. And the volume of trading was such, it magnified so quickly that essentially the phone call came in from the central clearer to Robinhood saying you need to find more collateral to back these positions, all right? Otherwise, we don't think potentially you're capable of making sure all these trades get honored. So Robinhood suddenly then had to go around cap in hand looking for money that it needed to put on deposit effectively at the central clearer in order to be able to promise that all these trades would actually be followed through, if that makes sense. They would clear and settle, as it's called in stock market terminology. And sounds a bit weird, but it's a convention, old creaky systems, if you like. Some would argue that behind the scenes, when you trade, it takes 2 working days normally for the stock to actually move from seller to buyer, legally, if you like, and the cash to go in the other direction. And in the middle, there's a risk. Things can go wrong. Clearing in the middle, settlement at the end. So where are we now? What's the outcome of all of this, and what do you take away from it as an investor, let's say? And I'm trying to use this as a way of explaining how the market works. So where are we now? The retail army, for the last time, that's this lot, moved on. All right, they moved on to silver. Now that is a very, very tricky market to try and play as a novice. Aside from the fact you're a novice, playing the commodities market, as the Hunt brothers discovered back in the 1980s, Google them if you're not sure, trying to corner the silver market is a pretty dangerous thing to do, because frankly, you don't know, for example, how much supply there is. If the price goes high enough, people might start going into their kitchen cupboards, melting down silver things and flogging them, all right? So there are lots of reasons why the silver market is quite difficult to predict. It is used in lots of different ways, industrial, jewelry, and for pure speculation. So anyway, after GameStop share price sort of started collapsing, if you like, so the bubble popped, the retail army moved on to silver, but that hasn't worked out too well either. And in the wake of all this activity, what do we got? We've got essentially legal cases being brought against Robinhood for, as some people see it, suspending trading. You know, outrageous. Didn't that buy time for the sharks to recover? Well, no, some of the sharks did lose money. Some of them made money. On the buying side behind this lot were some of the sharks. One hedge fund made 700 million US dollars, is estimated, by being on this side, not that side. So it just goes to show. The SEC are looking at it. That's the regulator in the US. What they're looking at is whether there's any evidence of insider trading using information that nobody in the market has. It's sort of unfair. It's not a level playing field. Probably no evidence of that. Market abuse, market manipulation, possibly, but then they'd have to look at both sides of the transaction. So I'm not going to try and call that one. But the SEC are doing an investigation. Lessons: an awful lot of investors who went in too late will have lost a lot of money. And you don't tend to hear about those stories in the pub. You tend to hear about the ones who made money, not the ones who lost it. Okay, so the motto, I think, and I'll hand back to Rachel in a moment and I'll be back for questions at the end, the sort of takeaways are, from an investment point of view, single stock investing, having a punt on a meme stock which has no financial stability, doesn't look like a good bet, but people are just buying it anyway. That's dangerous. All right, that's why we run diversified portfolios. Lesson number one. Lesson number two, trying to time the stock market is horrendously difficult. Everyone thinks they're going to buy low and sell high. Of course they do. But the greater fool theory says there's usually someone out there who is basically quicker and more knowledgeable than you are about what's going on in the market. In other words, you can fall prey to the sharks, basically. And there was a shark behind the kind of Reddit attack on the markets, as it turned out last week, a whale, as they're known in market speak. And so timing the markets is a bad idea. And the third thing is, I personally only believe in buying things you know something about. A lot of people do bandwagon trading, and that's dangerous. They hear, oh, GameStop, I'll jump in there. Now, fine, if you've got money to lose, if that money would have gone on a horse racing bet, which I'm not recommending, by the way, but if it's money that you just want to have a bit of a punt with, have some fun with, and you can afford to lose all of it, well, maybe. But as an investment proposition, these so-called meme stocks have proven themselves to be a little bit dangerous. And as to wandering into the commodities market and buying things like silver, well, that's a whole nother story, but I wouldn't necessarily go there either.